Hello YouTubers, and welcome back to the Independent Investor. Today I'm going to be talking about, as I used to say in the Monty Python movies, now for something completely different. Basically, the focus here will be on short selling. Short selling is where you try to take advantage of falling prices on an equity. So basically you borrow shares from an individual, then sell those shares hoping to buy them back later at a lower price than those shares that are borrowed are returned to that individual. Of course, it's not on an individual basis, but thinking of it that way, it makes it a little bit clearer to me how the process works. It's all done electronically. It is a very risky process in that if you do a long position, the most you can ever lose is 100%. If you bought a stock at $50, the company goes bankrupt, it's delisted, it will go to zero, you'll lose that $50 per share. On the short side, the losses are unlimited in theory, and that you could buy the same stock, short the same stock at 50, it could go to 60, it could go to 70, it could go to 100, and so on. Also, you can be right on a short position and it still might not work out. You could buy that stock, short that stock at 50, it might go to 60, 70, and then come down and even go to 40. But if there's a lot of selling, you might have to give up your shares and be forced out at a higher position. So there's quite a bit of risk involved. I just got into it over the last year or two just because I felt the markets were getting very expensive and opened some small positions. And then if the market did roll over, hopefully I could scale these positions up. And that way you're kind of staying in the market, you transition from a long to a short position, and then when the market starts to base, you start selling, cover your shorts and creating long positions. Every bull market usually has a main driving force. We saw back in the 1990s, it was technology. You had your Microsofts, you had your Dells, and then in the mid-90s it transitioned into within technology, but more to the internet, and we ended up with the dot-com boom, which we saw a lot of companies that didn't really have a good business plan that basically imploded. This bull market here has really been driven by the Federal Reserve. After the 2008 financial collapse, started in the United States and kind of radiated around the world. To recover from that, basically what the Federal Reserve banks did is print a lot of money. And I think the balance sheet in the Federal Reserve was about 800 billion. It's gone up to something I think like $4 trillion. And you got to remember there's a multiplier effect on that with fractional reserve banking. So if that money then goes to a bank, the bank can lend out 10 times that. So that's why they talk a lot about there not being inflation, and I think that's true because of technology, and we see prices of computers and a lot of goods actually decrease from year to year. But what we do see, and they typically don't talk about, is asset inflation. We see stock markets continue to go up. We see real estate in some areas around the world. Like we can look at Toronto, we can look at Vancouver, London, England. And a lot of this is being driven by this money that's kind of been printed. And that is a little bit what I'm going to focus on today, and how that's to some degree changed the fundamentals of the market. So one company that I opened a short position in probably over over a year now, a year and a half, and I've been wrong in it. It continues to go up. Is Domino's Pizza. In some ways, it's a good company. It has used technology to make ordering pizza easier. It's adopted. You can order a pizza from your phone. I think it's done things with Facebook. But one thing that's I think has mentioned occasionally, but I think there should maybe more focus on it, is that what it's done to some degree is borrow money from the Fed and at very low interest rates, and then it's used that money to buy back its shares. What this does, it drives up your earnings per share, because now you have, even if a company's not growing, if it does this practice, if you have the earnings being constant, but your denominator there is shares, and that is decreasing because you're buying back shares, then the EPS will go up. Domino's Pizza does have growth, revenue growth, so that coupled with the buying back shares, it's shown steady earnings per share growth, and then that there's more of an emphasis on analysts to report earnings per share. They don't dig into some of the other financial ratios, so it's very important to have a broad cross section of ratios when you're analyzing a stock. So, and especially the momentum crowd. The momentum crowd look at basically technicals. They're looking at the chart patterns, making sure it's staying up, supports are being maintained, and they focus on the earnings per share. They don't typically dig into the fundamentals as deep. And this, which I will show here, is quite interesting in that if we look at, might be difficult to see this, but if you looked at that pattern there, going from roughly 2009 after the financial collapse, from, we can say about $3.40 up to $220, you might think, wow, that's quite a company that's got some real major innovations coming out to the market. It's the next Google. Well, that's not the next Google. That is Domino Pizza. So again, a good company, but pizza companies, it's not the latest and greatest technology, and this is quite common. When you see one like this, you start looking in the same industry to see if something similar is happening, and to a lesser degree, it's happening in Jack in the Box right here. We'll be able to see that again. $20 up to about 110. That's just fast food hamburgers. Revenues are kind of flat, and we've got Papa John's Pizza. Again, similar movement, $80 to $84, which is tenfold or a 1,000% increase just over less than 10 years. So it's something not quite right when you see companies. Domino's has done a better job as far as actual growth, and if we drill into this a little bit deeper, we can start seeing here in Domino's case is back in 2007, revenues of 1.4 billion up to 2.4, so that's about a 50% growth, and that's kind of what you would expect the earnings may be in a bull market, maybe the stock goes up 100%, but not these 10, 12 times. And down here we can see the earnings have actually gone up quite well. We've gone from 61 cents to 441. But what's interesting is if you look down a little bit further, the average number of shares outstanding are worth 62. I think that's probably, I'm not sure if that's probably 62 million shares, and it's dropped to 49 million. So as I was saying, that's, you know, your denominator is lower, so this drives up the share price. So if we take the 62 into the 441, we see that the earnings would be quite a bit lower, maybe in the $3 range if you divide that out. And then typically you take the $3 and multiply that by a given PE ratio. So you could say a PE ratio maybe of 20 in a heated market like this would give you maybe a share price of 60 or $70. But it would be hard to come up with like $200, which we're trading at now. Another, if you move over to the balance sheet, this really becomes quite evident. We can see here, you know, your assets have grown from 473 million up to 800 million. But we've also seen debt go from 1.7 up to 2.1 billion. And what is probably really stands out, we've seen retained earnings that are actually negative. And that's because when you buy back shares, they go into a treasury, they call it treasury stock. And I think this case, what they've done is eliminated the treasury stock and adjusted their retained earnings for that. And then if you look at the total stockholders' equity, which when you divide that by the number of shares gives you the book value, or what's this company really worth. If you take the assets, you minus your liabilities, that gives you your stockholder equity, and that is actually negative $1.8 billion. So I can't say I've really seen anything like this before. I mean, you can, if your liabilities are a lot higher than your assets, you can define that as a company being bankrupt.